in the face if you if you believe what you read in the papers. I mean, that is the issue.
Sometimes people can have difficulty understanding why we're pursuing an austerity program, why we're trying to reduce deficits, why we're trying to get the national economies back into shape. And the reason is because it impacts on the ground via these mechanisms of the banks, the semi-states in terms of their cost of funds. Okay, and so you have to do the maximum you can there, because then it actually flows down into everybody's pocket, either in rates that they're charged by their bank in respect to that. The amount of standard variable rates in the system, I think, is around about a third of all mortgages. Okay, so it's a very significant portion of the mortgage population. And you're right that there is a historical book of trackers that have existed in the banks where people in effect negotiated or were given very good deals in the past. And that new pricing models have to go back to a more rational basis for which we reprice mortgages. But I also think it's important to remember that while mortgage arrears are a very significant part of the problem, and we worry about them and we want to get them resolved, they are still leaving over 85% of people actually paying their mortgages. And to the extent that those people are taxpayers, to the extent that the banks are not able to operate profitably, we would be facing the spectre of a new capital need for the banks into the future, which will come from the same people that are paying those mortgages. And so I think that this is, and from the perspective of the department, the most important thing is that we have set up relationship frameworks where we've given the management the ability to set commercial rates on a commercial basis, and we have to continue that.
That's good. Okay, I'll just finish with this point. I do think the department needs to take a look at the whole policy of this and targeting this cohort, to this group of people constantly, and maybe talk to the bank about how else you can actually become profitable, how you can increase your profit base by other methods, as opposed to raising these variable rates constantly, incrementally, steadily over time. The figures that I've been reading would suggest that you're looking at a 5.5% SVR across the board as the norm before too long. And my point is that I don't believe, well, at one hand we're talking about repossessions and the inability of people to pay, and then the acceptance of that occurring. I think there is a contradiction there. And I think the department must have a position on that, and at least talk to the banks about the effect that that's going to have on people who have SVOs.
I think the primary responsibility for making sure that customers aren't being disadvantaged by other groups of customers is in fact with the regulator in respect to the operation of the banks. And we clearly have that. To the extent that there are situations in which people are being charged a rate of interest on their mortgages that puts them in a position where they cannot pay their mortgage and they're falling into arrears, it goes back to the discussion we had earlier of wanting the banks to engage with those customers in terms of working out what is in fact an appropriate mortgage. And there are two ways to do that. You can actually move back some of the principal and apply the normal rate of interest and go back to the split mortgage situation if the average rate is too high for someone.
Okay, I'll change the subject. A quick question. It's about the property tax, and it's about where the money from the property tax is going. Different media reports about how that is being apportioned and how it will be apportioned. The figure of 60% has been used when it comes to, we'll say, funding local authorities, the rest going into a general fund. What's your understanding as to where the property tax receipts are going to go and how they're going to be used?
The connectivity with the fund is right. I think Derek has been here all day wondering what he should be talking about, so I mean, he's closer to the detail.
The property tax, the money raised from property tax will go from next year to back to the local authorities. The working group, the Thornhill group, suggested that about 65% of it should go directly back to the local authorities, with the rest going in for redistribution ground to an equalisation fund. The government are reflecting on that, so discussions are ongoing about how exactly what proportion should be, whether it should be 65, 70, 75, 80. They haven't actually made.
So there is no determination as to right now as to where that money is going to go.
I suspect it's how to put it. I think it's imminent. Some call on that, but it's a large proportion of the money. The greater majority of the money will go back directly to the local authority from which it is raised, with some equalisation then using the balance.
Okay, all right, fair enough. The third question I have, I suppose, is to do with the finance bill, and it has to do with the Living City initiative. And some of the definitions, or one of the definitions in the Living City initiative for Limerick and Waterford. Something I raised on the floor when the bill was being debated, and that is the definition of a Georgian house. It looks that, and within the bill, the definition would be that it would be defined as a building constructed in the period 1714 to 1830 for use as a dwelling, comprised at least 2 stories with or without a basement. Initially, when I met, for example, the Waterford Civic Trust and other people who know about these things will say in Waterford, my inclination, and they backed it up, and they said that I was probably correct. The footprint of Georgian buildings in the centre of Waterford isn't that great, and many of them would have been built from 1830 to, we'll say, the middle of the 1840s, in a style of Georgian architecture. They were Georgian inspired. The difficulty is that if the definition is tightly adhered to, you're not going to have any impact really on Georgian Waterford. As it's turned out, I got my hands on, I was sent the submission that the Irish Georgian Society put together, and they agree, and they talk about Limerick in particular, and that a large proportion of, we'll say, Georgian houses in Limerick, they date from the 1840s and the 1850s. I think we need to take a look at the definitions involved here, if it's going to make any kind of an impact at all on the section within the finance bill. I've talked to, again, people who would be kind of knowledgeable in this area, and they certainly believe that it should not end in 1830. Georgian-style houses were being built well into the 1840s. When I brought this up, it generated some mirth. I was giving a lecture on history. It actually is an important point. If this Living City initiative is going to have some kind of an impact with regard to the residential part of this measure. It's a really good idea. It's something that's badly needed in the city, the residential and the retail sector of this. I do think some thought needs to be given to the definitions and the kind of impact, though, that may or may not happen as a result.
Okay, I've learned more about Georgian houses today than I ever knew.
Sorry about this. I was meant to give you a lecture.
I think ultimately it's a policy matter. We'll make sure that the Minister and others know. But
during the course of the committee stage yesterday, I think the Minister spoke extensively on this. And what this is intended is to try to find something that is different to the type of census that existed before, and see if it works. About this, there's a lot to be learned from it. We're trying something effectively that's new, by trying to take the passive investor out and trying to stop speculative development.
Sure.
And I think they're both things to be welcomed. There's a learning process to go through on this. We have to go for state aid approval because of the nature of the scheme, so that's going to take, it'll probably this time next year, or certainly very late this year before we have that. There's an ex-ante cost-benefit analysis that will have to be done around this in advance of its implementation, and will probably be actually a condition of getting the state aid approval. So there's time to think about this. It's not a now. We've put the framework of what we're trying to achieve out there, and I think there is room to learn around it.
And look, as I said before, really all I'm looking for is a bit of leeway here, right? So give the people who actually would be expert in this area a chance to actually give input before any decision is made on the different sections. I know you have to go to, once the consultant report is finished, go to the EU grant aid approval process, or go through that, come back, take a look at this before the commencement order is signed. I just have a slight concern right now that in some cases it may not have the impact necessary if definitions are tightly written. So, fair enough. Last question. I've got two points. I read somewhere recently, Mr. Moran, that deposits in Irish banks had been reduced by about 13% in 2012. Is that your understanding? Is that a crazy figure?
If anything, I have in my head that they've gone up by about 9 billion over the course of the year.
Okay. There hasn't been a reduction then. It was something I read in the,
No, there are two things I can think of. One is that you have to be careful when we look. We report on the basis of covered banks, so the banks that government supported, because sometimes deposits so categorized in the IFSC can impact on the numbers. And then I think another important dynamic that's in the system is the value of sterling, as to what that actually does when there's a translation. But over the course of the year, I think the number I have in my head is it went up by 9%.
last thing I want to mention is, you brought it up, and Enterprise Ireland brought this up, when it comes to the banks and their interaction with SMEs in particular. The comment from one of the EI officials here a few weeks ago was that the banks were frankly not fit for purpose when it came to dealing with, we'll say, the non-financial issues. They made it clear that they were in some cases geographically challenged. They might have had some knowledge of the UK markets, but beyond that, they really didn't know how to assist people with exports and how to actually improve their exports. They had major issues in the area of information technology, and generally speaking, their ability to assist SMEs was lacking. And have you? I mean, you made the last time you were here, you made it very clear that you put together systems within the department to make sure that crazy decisions weren't made in isolation. And you explained that very well, but there's a proactive side, I think, to what you do, and particularly when it comes to the banks, to make sure that they're doing what they need to do when it comes to dealing with business, small business, medium-sized businesses, and assist them with the kind of information and expertise that's necessary if they're going to lend them money and everything that goes with that. And you have a pivotal role, I suppose, to make sure the banks are engaging in that. What's your experience been in the last couple of years when it comes to the banks in that area?
I think that one of the things that, and I was heartened this morning to hear somebody else say it on CNBC in another jurisdiction, because it suggests that we're not the only ones having that problem. And they mentioned this issue of that banks are in the business of providing credit to companies, but are not necessarily in the business of providing sort of capital. And I think that one of the focuses in the past year, since I suppose we were here last, in respect of this, has been how we can work on the provision of alternative balance sheet repair mechanisms to banks that are in the trouble. I mentioned earlier the sort of the categorization we have of the three types of companies. We try and deal with the micro companies on one side. We then try and deal with the exporting and good companies, and then we deal with the ones that are in trouble. And we have been working with the folks down in the NPRF. So there's almost about close to €1 billion of funding now provided, or being provided in respect to three types of funds there, one of which is targeted at this issue of trying to restructure sort of the medium to larger companies in terms of their balance sheets. And I think when we see that feeding through the system, I think we will see a greater flexibility in terms of people's borrowing choices and the ability to take funding from the system. But I think we will be still faced with the problem into the future, which we didn't have in the past, and it needs to be addressed, and we've identified it as something that needs to be addressed, which is that we are a very open economy, significantly dependent on the ability of our companies to export. Yet our banking system has in effect gone in the opposite direction. As European banking systems are going through the resolution of the banking crisis have become more national rather than international. And our own banks are certainly in that scenario. And so we need more mechanisms, and we're working to try and provide more mechanisms of support whereby our banks can either be teamed up with banks externally in markets where our companies want to export, or alternatively, that the banks in those jurisdictions are encouraged to have operations here in Ireland. And so what we've been doing, you spoke about some of the things we've been trying to do to break through these, is we have a group that now meets every 2 weeks, which involves Enterprise Ireland, our colleagues over in Jobs, the Department of Education, who have an important role to play in terms of teaching the managers of companies how they should run their businesses and produce things, and other state-based stakeholders to try and drive all these various initiatives, including the NPRF, are also there, and the NTMA, to try and work these situations out. We have also taken advantage of a program that we're running in the department where we're bringing people from other treasuries to come and work with us in Jim's area, in the international area, so that we can do bilateral reviews to compare the banking systems in Ireland with the banking systems in other jurisdictions, not in a broad sense, but just focusing on whether or not companies and trade between the two jurisdictions has the right level of support. And we're starting with France and Ireland and the UK and Ireland.
Okay. Fair enough. Lastly, just going to reiterate what Deputy Donoghue said before he left. Do appreciate the work that you do. It's high stakes for Ireland right now, and there's been a lot of progress in the last year, so thanks very much.
We appreciate the work.
Thanks, Deputy DC. Mr. Moore, before I ask you a number of questions in relation to the CNAG's opening remarks this morning, I want to join with the other members in complimenting, I suppose, the Minister, yourself, your staff, on the progress that you've made in the last 12 months, and certainly on the amount of, I suppose, intelligence and information that you've picked up. I know it's not easy from a legal point of view or from a banking point of view to understand all of what is happening at a quick pace, particularly when you're in your back is to the wall and you're trying to learn as the markets are moving under you. But you certainly have made a lot of progress. In the CNAG's opening remarks, he goes through the figures of the general government debt since 2007, and the estimated debt of 192 billion in 2013. Would you comment on the figures to date, the up-to-date figures? What is the indebtedness of the country and the amount of money having to be paid back to service that debt over the next few years, and taking into account I suppose the deal that's been done so far on that debt and a possible deal and what that might mean in relation to the repayments? Okay.
I mean, there are a couple of things to say. I suppose we have the chart that's in our document, which suggests where we think the debt will peak at. Yeah. I think we are now looking at a situation which is an interesting juncture, where the cost of funds from the program is about 3.36% on sort of an average basis, and we now find that we are getting to a position where the borrowing rates for the state at large have come within that parameter. So I think we're looking at that, and I think any additional savings that we can make in respect of that will, in actual fact, represent a positive with respect to the budgetary projections that we've made, because we have an assumption as to the cost of funds going out, which is from information fed to us by the NTMA, and as they go back into the markets, then we will actually see sort of, that feeding in a positive way back into our fiscal numbers. I think we have indicated that we expect the debt to peak at the end of this year and to start to decline thereafter, and unfortunately that will decline at a very slow basis. I mean, I think we have the number here of debt in the Irish situation in 2007 was only 25% of Ireland.
The cost of that year, in terms of the repayment, year on year, the interest, what are we repaying? What is the figure relative to the repayments?
I have that number.
2013 provided the sum of 8 billion. So to take us through from, say, 2008, what we were paying, up to the figure of 2013, which is the highest point in your graph here, costing 8 billion. So we've seen the growth pattern up to then. And how long does it stay at that level? And what is the movable part of that? Would it be 8 billion, 7 billion, because of the deal that you're doing? Because of the interest rates on the other side. So those two things.
Yeah, well, we don't have I mean, do you want to take the exact, the numbers that are in the accounts, and you can kind of tie them all together?
I'll just refer to the Budget 2013 document, which projects the government interest expenditure to 2015 and projects that as a percentage of GDP at 5.5% in each of the 3 years, 2013, 14 and 15.
Which is the 8 billion.
That's table 11 on page C20 of the document.
If that in money, that's what you mean, isn't it? Yeah.
What will it cost to service the debt?
So in euros, the numbers for 2013, 14 and 15, again from the same table, are 9.3, 9.65 and 10 billion.
Billion. And what will be the impact on that of the markets? Well, first of all, that 8 billion from 2013 up to 10 billion in 2014 or 15 is affected by the cost of funds and so on. So what is the fluctuation that will take place between or in that market?
You see
That will reduce the figure.
Well, you'll see very little impact on the historical debt, because the traditional way of issuing debt in government debt is actually as a fixed rate, which is actually one of the features in the new promissory note replacement bonds that's somewhat unusual, because they're floating rate bonds. So that where the savings comes in is, and I don't think we have a document I can show it to you, but it is in the debt as it is replaced by the state. Then to the extent that it can be replaced at a cost of interest that is less than the interest currently being paid on the debt, we will start to see a...
That's 2015 onwards.
As soon as we start, yeah, well, we have some debt that we will be replacing even at the moment. So, for example, as debt would
But
roll off...
significant sums.
But significant sums, yes, because most of it has been rolled out.
So you could say that as a yardstick for the next number of years, 2015, the debt repayment figure will range between the 2013 figure of 8 billion and the suggested figure Mr. O'Neill gave us there of 10 billion. That's not going to change.
Should not change very significantly.
So that's the level of repayment of debt that we have to meet. It just helps the
Yeah, no, and one of the things I think...
one of the things that Deputy Ross was raising, which I just want to address in relation to this, is the openness of the department. There's a greater openness there than previously. And what he's encouraging you to do, I think, in terms of his question, was to attach to the table which is in this report which you gave us this morning some names of the senior people within the department. So we know who's reporting to who at that senior level, and down then to a level where you don't want to get into names and people at some sort of middle management down. And that gives a greater openness as well. And what I'm trying to do here is to add to that, and I think you should do the same thing, because you're moving in that direction, is to explain in terms that are understood by the public just exactly what debt we're faced with, what repayments we're faced with. And that figure helps to understand that regardless of what happens between now and 2015, our debt repayments will run in the region of 8 billion to 10 billion because of the historic situation where we were tied into an interest rate which was fixed.
We have no problem producing that else. I mean, one of the reasons why we're a little vague here is that the numbers are actually run by the NTMA. So in that sense, we only get the total numbers. But I'll talk to John and we'll work out how we can actually produce something.
If you let us have those numbers,
no,
it helps
that's
us
no
to
problem.
understand as well, because like you, we're on a steep learning curve here when it comes to the Department of Finance and European Union and Troika funding and all the rest of it, and we want to stay at pace with yourselves. So if we could have...
We'll produce something, that's no problem. Because one of the things I was looking for is another important metric is also the percentage of tax revenues that are actually used up in interest, where in fact relative to the 80s, we are in a better situation now than we were at a time when we would have had a very extreme debt situation as well. So we'll produce something on that.
If you would. The other point I want to raise is in relation to the liabilities and the future pension entitlements. And an estimate was provided in 2009, that the amount was 116 billion. Now, according to the CNHE's comments this morning, there are lots of changes have taken place in public service pay and so on, and commitments. What is the current liability?
I don't want to sort of necessarily dodge the question, but this is ultimately a question for the Department of Public Expenditure and Reform, who would be responsible for looking at that. And I think there was a recommendation indeed in the report, and they're dealing with that matter in terms of greater redoing.
Who's dealing with the CNHE's recommendation?
That should be the Department of Public. That's the Department of Public Expenditure and Reform.
Mr. Quigley, have you that figure?
I don't have that figure, no, not offhand. Work is being undertaken in the department. Could I suggest that it would be subject that could be discussed when the superannuation and retired allowances vote? My recollection is that that's coming up quite quickly, and the cost of public service pensions and public service pension policy generally would I suggest be the
well, as we prepare for that, would you ask your department to give us some information?
Certainly.
On the figure of 2009, that figure of 116 billion, and any other information that they might have which would inform us beyond that point?
Certainly.
Relative to the figure and the exposure of the state on that. And also, if the department has taken up the recommendation of the CNAG regarding the actuarial reviews which should be carried out.
Certainly.
If the department has, and reviews have been carried out, you might let us have the outcome of those reviews.
Certainly.
Okay. The bank ownerships, the ownership of the banks. What are the signs within the banks, or are the banks showing signs of not needing the state support? Are we beginning to see a light somewhere in that dark that tells us?
I think we certainly see a light, and that's reflected in the decision to take off the guarantee that we've done this quarter. To us, that was the big statement. I mean, although the underlying liability had considerably reduced from memory from about over 350 billion down to about 75 by the end of last year. We are now in a situation where, and we have been for some time, and so that we felt this was the quarter in which we could release the state from that contingent liability. And in monitoring the deposit flows of the banks, we don't see any negative impact in respect of that, and we feel that in many ways that is a recognition that the public were looking now at the banks in terms of the strength of the banks on their own, rather than necessarily them needing to be supported for the deposits. Bearing in mind, of course, that there is already a deposit guarantee system in place up to 100,000. Therefore, the next focus from us now in terms of continuing to break the link between the two will be to try and reduce, as we started earlier this year, the investment that the state has in the banks. So we've started with the instruments that in many ways are the easiest, which are the contingent capital instruments. And we will work through from that through to the preference shares and ultimately to the equity of the banks.
So do you see them being in state ownership for another number of years?
I think it depends which bank we're talking about, but I think we certainly have to be assuming...
AIB, obviously.
Yeah, in the case of AIB, there's a very significant restructuring job to be done. And we have a scenario where the international banking sector is not particularly strong. And so, as is indeed the case, and that I know the Treasury are struggling with the same issue in the UK, it is difficult to see a full transfer of a large bank like that into private ownership in the short term. But we will continue to work, as we've done with Irish Life, with those parts of the system that we think that we can manage.
I don't want to pin you down to time, but short term is years.
Yeah, I know, certainly.
Would you agree with that?
If we could find somebody quicker, we'd be very happy to overperform.
All right. Maybe just a comment on the public interest directors, because other members have asked comment on it. And I would have presumed that by public interest directors at the time, what was meant was that these public interest directors would look at the activities within the bank to ensure that, as far as the state was concerned, and therefore the citizen, that they were behaving correctly instead of badly, which is the way that they were behaving, in terms of their governance, their activities with customers and clients, their lending criteria, all of that. And to be quite frank about it, they're not doing a very good job, in my opinion. They're getting paid well for what they do. They have a particular role which need not necessarily clash with their duties as directors, because I would imagine that what I would expect from them is what the citizen would expect, and I think that can be equated to good governance. So there's not a big deal here, with the exception that when we talk about, without wanting them to interfere with the SME sector, but when we talk about the lending to the SMEs, the truth is they're not lending, Mr. Moore. And that's been commented upon by the national bodies representing businesses and general economic commentators. And the figures that you're getting are to a degree massaged. That they're figures that, for example, Deputy Donoghue, I think, was making the point this morning that people make an application, but they don't become part of the analysis until they're actually looked at and said, yeah, you can continue with that application, it's likely to be approved. They're not part of the analysis. They're outside of it. So when you go to the bank as a business, you could come out with a restructured overdraft, termed as a loan, and no overdraft at all to continue on with your business. Or you could present requesting a loan and be analysed without being brought into the system itself. In other words, they talk to you about the loan, but they don't process your application. And therefore, you're not part of the statistics that are eventually presented to the Department of Finance or indeed elsewhere. And I would have honestly thought that the public interest directors would have called the bluff on the banks in relation to that activity. And likewise in relation to their legal services department. It would appear to me that that process is held up and can be held up for anything up to years. Now, I'm breaking this down too for you in relative to, say, High Street Ireland, those retailers that are in difficulty, people who need an overdraft to continue on. You can extend it into an industry that I'm familiar with, the transport industry. You can go and take it into people that already have debt with them because they've built up a property portfolio on the back of a good business. And the banks don't deal with it. And the public interest directors don't blow the whistle on these guys. And you can't do much with them because the stats that are being presented to you do not exclude this activity. So the banks, to a degree, have their head in the sand about a lot of this stuff. And I would have hoped that the public interest directors and the Department of Finance would be a little bit more difficult in dealing with the banks to get them to respond, because they're closing businesses in this country and they're ruining the potential of good entrepreneurs to create employment. And I'm presenting that to you as a fact based on information gathered at my own clinics or listening to business people in their own organisation expressing this. We had a submission from RT Data recently which talked about all of this. And the banks were central to the criticism that they had. Is this something that you would take up with the public interest directors?
Yeah.
Or that you would bear in mind in relation to the policy as it's being developed by the banks?
There's a couple of things. We take this up with, as I mentioned earlier, we're now meeting, in the case of the banks, with as many of the board members are available on a regular basis. Most typically ourselves and myself and the Minister. And we have an agenda which I can assure you includes not just mortgage arrears but also lending and SMEs. So we raise it at the level of the board to make sure that they are putting as much pressure as they can on the banks. We also do that indirectly by the fact that we want and insist that the banks should move towards profitability, and the banks understand that the only way you can become profitable is to lend money. There's no point in actually not being in doing any sales in terms of loans, otherwise you will not be able to generate any profits. I mentioned earlier sort of shared frustration on the mortgage arrear side, and equally here, we continue to try and figure out what we can do with this, but we are not the only Treasury struggling with this. We've hosted conferences with people across Europe to try and understand if there's any tricks that there are any techniques that we're not using here. We have an SME funding group which involves people from across the system to make sure that there's a whole of government approach to this, which meets every 2 weeks in my department. We then have a stakeholders group where we bring the banks in and all of those participants and indeed the representative bodies for all these various companies, the tourism sector, the SME sector and everything else. And I've almost threatened to sort of start publishing the minutes of that meeting so people could understand sort of where we are going. We send out consultation papers to try and see if there is anything else we could do. And we do not necessarily hear all the solutions either from even the industry bodies as to what more we could be doing in this sector. I think the banks have come from a position where they haven't been well positioned to do this lending. Certainly 2 years ago when we were here, their banks were in even much worse shape than they are today. But I think that the difficulty that we still face in respect of a lot of companies that we talk about is a more complex issue about high rents, overhang of public debt, and balance sheets that in many respects are also lacking enough equity for banks to be able to make loans. Now, that's not to say that there aren't issues still in the banks, and I think the fact that we see and engage with the credit review office as much as we do on situations is in fact the case. When we get a particular scenario or customer that has had a problem with a bank where it's not appropriate for us to intervene in respect to that customer, but we can pass that on to the credit review office even in scenarios where they aren't statutorily entitled to engage, because for example if the loan is above their limits, and they have assisted us by actually then engaging with the banks to try and understand what is the situation. And in some cases that has also resulted in solutions. In other cases it has frankly resulted in an analysis which says the bank's decision has been right. But I think there is a complexity to this discussion. I think the funds that we have introduced with the NPRF should add very welcome and necessary equity type funding into the balance sheets so that we can try and work out the more important employers. I think we have still got the scenario I mentioned at least earlier of smaller companies not necessarily running themselves as well as they should to get loans, and situations are tougher. But we have scenarios where we can't understand. We have a microfinance fund with almost no applications. That is very strange in the context of what we're otherwise hearing about small companies not being able to access funding. And it's in the maybe 100 or 200 applications on a microfinance fund, where we were initially worried that we would be inundated with applications and we're not getting any. We have AIB have issued a new product at the end of last year where up to 25,000 of lending is available to existing customers in, I think it's a 24-hour time approval. And again, it's a handful of applications. And so there is a serious issue also with demand. Now, it could be that the demand has been weakened by people's belief that banks aren't lending. And banks do want to lend. Whether they are well equipped to do it or not, I don't know. But it's important that that message is actually...
I think that the business sector have got that message. My concern is that having received the message, they examine their own state of affairs, which is what they do to prepare for a bank loan. What's not being acknowledged by the bank is the historic debt that's there, because a business may have diverted from its core activity to maybe and I'm talking about family-owned businesses, single entrepreneurs and so on, they may have bought another property. That property may not be performing, and it's hindering the growth of the core business, and the bank is not dealing with it. It's simply allowing it to struggle on, a business that may be sustained on a base that for 2 years or more, but it's not possible in the long term. It's not feasible in the long term, and the banks don't address it. And you know, my issue is that and it was said by Enterprise Ireland in relation to a whole other sector, that the bank doesn't seem to understand the new tools that are necessary to deal with the business problems that are there. And that's the point I'm making. And I suppose in simple terms, we give the banks money. They've by and large been supported by taxpayers' money. Your department and the Minister negotiate deals in Europe and you extend out the mortgage term for the state debt, for the bank debt, and we're assisting them at every turn. They're not delivering that type of assistance to their own clients within the banks. And that's what the citizen and the entrepreneur, the business, require. Otherwise, they'll never recover. And the bank don't seem to get that. And I just wonder, are they getting money too easy? Do they not understand the policy relative to the money that they're getting? Are they just not capable of driving the change that's necessary within the banks as quickly as is needed for our business? And that takes me back to the public interest directors. You said earlier on in answer to Deputy Ross that maybe your bonuses, I think he was discussing then, was about performance, and that's how bonuses are given. Well, maybe we should look at public interest directors and not pay them if they're not performing, because they were given a certain role to play, and they don't seem to me to be playing it. And the banks who are getting money, because of the necessity to rebuild them, but yet they're not appreciating the fact that they have to turn around and help the other end of the economy. That's just a point I'm making, and it can be applied to mortgages and repossessions, because I share the views of other members in relation to repossession. I think that when that legislation is passed, you're going to find a very steep climb in the repossessions, because the pitch will probably be cleared. The banks have identified their customers that are in trouble, and it won't be a happy sight for people. The other issue which you raised yourself is just an issue of rents, upward-only rent reviews. And I'd like to get your view on this as the Department of Finance. You have properties that are leased, that are locked into upward-only rent reviews. And my information is that a number of clients that are locked into those leases have tried to negotiate with the relevant departments, and they failed, particularly around the ports. In fact, one particular individual sent the keys back in the post to the Department of Agriculture. And while we talk politically about dealing with legislation to cover the private sector and upward-only rent reviews, we have quite a number of them ourselves. My government has. And I would ask you to let me have a note on, I know that it's broken down into each department, and perhaps the OPW have a role here, which at one time was with finance, but I'd like to get your view on it. Will the state enter into negotiations with those tenants of governments that have upward-only rent reviews in their leases to establish if they can assist them, as we're doing in the private sector, by reducing rents and giving them some sort of breathing space to get out of the difficulties we're in?
The only part of the system that in a sense is within our framework is the loans that, or the leases that NAMA have, where I think the management of NAMA have already mentioned in other scenarios that they have already granted, I think it's over in excess of 200 rent abatements on their properties, which includes sort of,
They're private properties, aren't they?
the NAMA properties that they are renting, or that they have taken over as part of the process of taking the buildings out of the bank's
I'm
loans.
talking about properties that are owned by the state.
I realise, and what I'm saying is that that's the only part that we can. You ask for a note on this, and I can ask Robert Watt to produce that note, but we don't have direct.
But that's now with
public expenditure. Yeah.
What can I ask, Mr. Quigley?
Yes, well, we can prepare a note on the subject for you and send it to you. Your exact query is the instance of...
The number of properties that are owned by the state that are leased.
Yes.
that have upward-only rent review clauses within that lease, where tenants have attempted to negotiate and failed. And in one instance that I'm aware of, in Donegal, he sent the keys back in the post. That doesn't, you know.
Yeah. No, we'll follow it up and provide you with the information. It will be mostly from the Office of Public Works. We'll follow up with the Office of Public Works.
Okay. To go back then to the CNAG's comments again, just to finish with the remarks. The budget this year, when can we expect that? October or December?
We get a break this year. We're going to finish the Finance Act and go straight into the budget. I think because of the European semester changing, we're looking at the budget in October now.
Late October, is it?
Later, early mid, I think it has to be by the 15th, right?
The government probably make a decision over the next couple of weeks, but legally, once the EU arrangements, it can't be any later than the 15th of October.
15th of October.
No later than the 15th of October.
Okay. On Quinn then, and the money being provided there, the CNAG made a comment on that this morning. Would you let us have the up-to-date on that?
We can give you the up-to-date. I think Anne has the...
Yeah,
730 million went.
yeah, there's now 889.75 have been given. That includes 154 given in January this year, given to Quinn by the Exchequer as loans.
Okay. And the requirement is 1.65 billion.
That's the maximum requirement. The best estimate that they've given us at the moment is somewhere between 1.1 and 1.3.
So that hasn't changed?
That hasn't changed.
Okay. All right. The last matter I'd like to ask you about is one that the committee is dealing with at the moment, and it goes back to the work of the last Public Accounts Committee. It brought together, or asked, the Department of Finance for documentation in relation to the bank guarantee that night before it and after, how the decisions were reached and so on. And we got a considerable amount of documents from the department. Now, they never finished their a report on it, but we intend to undertake a report in this area, linking it to closing the circle, as it were, what happened back then, and right up to date, and linking it into a report from the CNAG. A lot of those documents were heavily redacted for one reason or another. I can understand at the time that those documents might have been redacted on the basis of commercial sensitivity, or perhaps at the time there was a legal issue in relation to the particular document. Would you undertake, Mr. Moran, to look at those documents that were provided to the Public Accounts Committee at that time and consider giving us the document without it being redacted? And would you look at whatever other documents might have been uncovered in the department, whether it's between ministers or between officials, that might be of interest to us in the context of that report on the banks, or the financial collapse and the bank guarantee and so on? And finally, in relation to that same matter, it always puzzles me that we don't know who was in and out of the department on that famous night. Would you look at the records of the department in case they might be of help to us in terms of that report?
As to what we can release, I'm more than happy to release as much information as we can. So, I mean, I can certainly say I wasn't in and out of the department that night, so that's the one thing I can say. But we'll try and see if we have records of people coming in and out and do that. I think the commercial sensitivity issue, there is, I think, merit in looking again at the documents, because it may be things that were commercially sensitive at a point in the past because of the passage of time and events that have gone beyond it, maybe less so now, and we'll endeavour to go through
My
those.
intention here is just to put you on notice about the report itself and the work that we're undertaking. and we hope to do that over the next few months. But the documents are important to us. And since those documents were released, letters were talked about, maybe the pressure that the Minister was under from Europe at the time, correspondence in relation to that, maybe some other internal correspondence between officials that might be helpful to us in relation to the report. And certainly, from the point of view of record, I'm sure that your department, reflecting on it now, would know just exactly who was there at the various meetings. And from the Public Accounts Committee, point of view, I think we would certainly like to know, so that we can include that in our reflections of that period from then up to now.
Okay.